Hello. So in this video, we will be covering basics about Forex trading, okay? Forex and CFDs trading. So our first portion of our curriculum is what is Forex and CFDs trading, okay? So Forex trading which is also known as foreign exchange trading involves buying and selling of currencies on the foreign exchange market, okay? When you're selling or buying the foreign currencies like US dollar, euro, JPY, which is also known as Japanese yen, okay, or US dollar, Australian dollar, New Zealand dollar, whatever currencies when we are buying or selling the foreign currencies against each other on a foreign exchange market, this is known as Forex or foreign exchange trading, okay? So Forex trading or Forex is the largest and the most liquid financial markets globally, okay, with a daily trading volume exceeding $6 trillion, okay. So Forex trading or Forex market is the largest financial markets in the world, okay. It has a daily uh, trading volume of $6 trillion, okay. So what essentially we do in a Forex trading, okay? While trading the forex market, the traders speculate on currency pairs price movement to profit from fluctuations in exchange rates. Okay. So this means that when a trader involves in a forex market, okay, he is either buying or selling. Okay. So what he aims to achieve is to profit from the fluctuations in the exchange rates. Okay. Whatever the exchange rates the price is giving us, right? Or whatever the exchange rates are posted in the forex market, the traders try to speculate and trade the those price movements. Okay. And his only aim is to profit from the fluctuations in the exchange rates. Okay. Okay. Now the currency pairs are quoted in terms of one currency's value against another. Okay. In a forex market, the currency pairs are quoted against each other. For example, euro and US dollar. Okay, euro, US dollar, British pound, JPY. Okay, so that's how we do it. Okay, so traders can go long. Okay, we also say that traders can buy or traders can go short or traders can sell a currency pair based on their exchange rate predictions. Okay, various factors influence currency movements. Okay, so what factors actually influence the currency movements? There are various factors. We call them as the fundamental economic indicators. Okay, and the other things which influence the forex market or the other factors which influence the forex markets are the geopolitical events, central bank policies, and of course the market sentiment. Okay. So forex trading operates 24 hours a day, 5 days a week. Okay. So it's 24/5. It's not 24/7. It's 24/5. It operates 24 hours a day, 5 days a week, Monday to Friday. And the forex market is closed during the weekends, Saturday and Sunday. Okay. Offering flexibility in trading schedules. While potentially lucrative, forex trading carries risks such as market volatility, leverage, and geopolitical instability, requiring careful analysis, risk management, and disciplines. Okay. Okay. So the forex market or the forex trading might seem lucrative to any trader, but it also carries inherent risk. Okay. These risks are in the form of market volatility, leverage, geopolitical instability. So a trader needs to do a very careful analysis, and he needs to adopt a robust risk management techniques, and he needs to adopt a discipline in order to sustain and profit from the forex market. Okay, this is very important. Now, the key aspects of forex trading. First of all, we have a definition of forex. Okay, so forex stands for foreign exchange trading. Okay, forex stands for foreign exchange trading. Now we have to understand how does this word forex derive, or how does this word forex came into being. Okay, uh, what's the logic behind it? So I've given a diagram here. All right, you can see here. Now you can see forex stands for foreign exchange. So FOR from the foreign and EX from the exchange, when we combine together, it becomes forex. You can see over here. All right. Okay. Market structure. Forex market is traded on a decentralized or spot market. Okay. Directly between market participants without a central exchange. So what happens when you are involved in a forex market? There is no central exchange. Okay. It's a decentralized or spot market where the participants or traders, they trade against each other, okay, directly. Okay. So it's like trader versus trader and trader versus liquidity providers. Okay. So I gonna delve deeper into liquidity providers later on in this video, but for now you just have to understand uh, the key terms of the forex. Okay. The trading mechanism. Traders have the right to sell or buy a currency pair with no obligation to own underlying asset. This means that the traders can only buy or sell a currency pair. Okay. There is no obligation upon the trader to actually own that underlying asset. Okay. So forex trading is essentially what when we are trading in the forex market, we are actually trading on margin on leverage. We're gonna delve more deeper into this margin and leverage later on. Okay, leverage impact. Leverage enables traders to control larger positions with less capital, amplifying both potential profits and losses. So what essentially is a leverage? Leverage leverage is like, okay, let me give an example. Okay. When a trader enters in the forex market, he does not have a lot of capital. Okay. All right. So what he does, he employs the leverage. Okay. So leverage is a type of a loan which you take from the broker to make your positions larger or to control the larger position sizes. Okay. So you have a less capital, but you take an extra loan from the broker. They provide you the leverage, okay, so that you can play with the larger positions. But there, and this results in a greater potential profits. Okay, the profits and the gains when employing leverage are huge. But if you are not having a risk management technique, a proper or a robust risk management techniques, you're gonna sustain a lot of losses. Remember that. Okay. So accessibility. Accessibility is the availability of leverage. Forex trading is accessible. The availability of leverage makes forex trading accessible to retail traders, but it's also increased the risk of significant losses if not managed properly. So what is accessibility? What is the accessibility of the forex market? First of all, the forex market has a low entry barriers. Okay. This is not written here, but I'm just telling you this point. Okay. So in a forex market, there are low entry barriers. For example, when you are trading in a stock market, you need a few qualifications and you need to have a qualifying capital in order to participate in the stock market. However, in the forex market, there is no entry barrier. You can even enter the forex market with the $10, $50, $100, $500, $200. Okay. So even if you have low capital requirements, there you can, even if you have a low capital, you can still enter the forex market. The second thing is that there's a leverage. You can utilize the leverage in the forex market. Okay. And this option or this option of leverage makes the forex market very attractive to the retail traders. Okay. And the influencing factors. Forex trading is influenced by economic data releases. Okay, as I've told earlier, so that forex trading is influenced by economic data releases and fundamental economic indicators. Okay, central bank policies and decisions. Okay, geopolitical events and even the market sentiment. Okay, these are the influencing factors that influence the forex market. We have also discussed this previously. Okay. Let me show here. Yeah, here. We have also discussed this previously. So these are the influencing factors of the forex market. Now, skill and knowledge. Okay. Successful forex trading requires a solid understanding of fundamental and technical analysis. Okay. So if you want to be successful in forex trading, you need a robust and a solid understanding of fundamental and technical analysis. These are the type of analysis which are commonly used in the forex market to analyze the market movements. And you also should have a solid risk management strategies, and you should also have a discipline, emotional control, and a great mindset in order to operate successfully in the forex market. Okay, so keep these things in mind. Okay. Okay. So now we have actually covered basics of the forex trading. So I'm gonna give you a very, very detailed or a brief review of it. Okay. So first of all, okay, the foreign exchange of the what is forex? Let me write it how. Okay. So foreign exchange trading. So once you combine these four, like for the taking four from here and X from here, what we get it when we combine it, we get Forex. So this is how the Forex, the word Forex is derived. Okay. So foreign exchange. So what happens during the Forex? We are trading currencies. We are trading currencies and we are anticipating the foreign exchange rates. Okay. All right. So we have covered pretty much over this through this document on this document, right? So I advise you all to read this document very, very carefully over and over again to get a basic idea and to get a basic perception about forex trading. Okay. It's very simple. If you read it 2 to 3 times, you're gonna be good with it. Okay. Now the CFDs overview. Now, what is CFD? Okay, CFD stands for contracts for differences. Remember that. Okay, the CFD stands for contracts for differences. Okay, they are derived financial instruments. Okay, they are derived. They are not the actual financial instruments. They are actually derived from the original financial instruments. Okay, that allow traders to speculate on the price movement of various assets without owning the underlying asset. Okay, you speculate and trade on the price movements of various assets, but you have a right to sell and buy those assets, but you don't have a right to actually own that asset, underlying asset. Okay, this is CFDs. Okay, now CFDs are popular for trading stocks, indices, commodities, currencies, and cryptocurrencies. Okay, traders enter into a contract with a broker to exchange the difference in the asset price between the contract's opening and closing price. So what happens when you're trading the CFD, you actually enter a contract with a broker, okay, with your broker, with a trading broker, okay? And what you're doing, you are actually exchanging the difference between the assets price, okay, assets opening and closing price. Okay, when you are actually speculating between the assets opening and closing price and the price changes of the assets, you are basically employing CFDs. Okay, you are basically indulge in the CFDs trading. Now CFDs offer flexibility, allowing traders to profit from both rising and falling markets. Okay, in a stock market where you are only buying the stocks, and when the stock goes down, you are sustaining the losses. Okay. In CFDs, it's very different. You can buy as well. When the price is increasing, you can buy. And when the price of an asset is actually falling down, you actually sell that asset. Okay. Now, let me give an example here. For example, you have a stock. Okay. You have an Apple stock. Okay, you have an Apple stock. All right. So we are involved in stock trading, for example, a normal stock market. All right. So we have a stock market, and in a stock market, we are buying the shares of Apple. What we got, we buy the shares of the Apple. So we became the owner of our shares. So what we become? Shareholders of the stock. Okay. We own part of that stock. All right. So when we become the shareholders in a stock market, when we when we become the shareholders, we actually own the part of the stock. So what happens if the price goes up? Okay, let's suppose if the price of the Apple stock goes up, okay, our profit will increase. Okay, but if the price of the stock will go down, what you can do, you can only sell your shares, you can only limit your losses, you can just dissolve your buy trade, or you can just dissolve your buy investment. Okay, all right, but you cannot short sell the stock, you cannot sell the Apple stock in order to profit, because you cannot just like, for example, you have 3 shares of Apple. Okay, you bought it, and when the price of the share increases, your profit will also increase. And when the price of the share decreases, you have to sustain the losses. You cannot just bet on the falling market. What you can do, you can just sell your Apple share stock. Sell here means, for example, you have 3 shares. Now you sold your 1 share, and now you have an ownership of 2 shares. Okay, so you are only selling your shares. Okay, and you are buying your shares. Okay. However, in the CFDs market, because you don't own the stock, own the stock, so you can profit from both buying the stock, okay, and you can also sell that CFD. You can also buy that CFD stock. Okay, so you can profit from both movements. When you're buying, when the price increases, you profit from it. When you're selling, when the price decreases, you profit from it. In the stock market, you don't make a profit from selling. Okay, you only make a profit from buying. When you're selling the shares, you are only limiting your losses. Remember that. There's a very, very fair difference between the stock market and the CFDs market. Okay, all right. So let's get back to the document here, and let's read more. They provide leverage. So just like the Forex market, the CFDs market also provides you the leverage, okay, enabling traders to control larger positions with a fraction of total trade value. Okay, what does this mean? That as I explained you earlier, what is leverage? Leverage is a trader employs a leverage when he does not have enough capital and he wants to trade the larger position sizes. So what he does, he takes a loan from the broker. That loan is known as a leverage in order to control the large position size. Okay. So what happens that you magnify the profits. Okay, the profits are magnified, but also the losses as well. If you don't have a solid risk management technique, you will also sustain heavy losses when you are trading on a leverage, or when you are utilizing leverage, or when you are trading on a margin. Okay, remember that. CFD trading involves no ownership of the underlying asset. As I told you before, in CFD trading, you don't own any underlying asset. You are just speculating on the direction or on the price changes of that asset. That's it. Okay. So what are the benefits? When you don't own the stock, you reduce the associated cost, such as taxes, stamp duty, and brokerage fees. Okay. When you don't own any stock and you are just speculating on the price direction of the stock, you get rid of the taxes. Okay, you are actually reducing your taxes. There is no capital gain tax or other taxes imposed on you because you're trading on CFDs. Okay, and you also get rid of stamp duty, and even you reduce your brokerage fees. Okay. Now, the key aspects of the CFD trading. CFD stands for contracts for differences, which are the derivative of financial instruments allowing traders to speculate on price movements of various assets. As I told you before, CFD stands for contract for differences. So how does it derive? So let's suppose we have a contract for differences here. We take the first word, okay, the first letter or the first alphabet of every word. Contract, we take C from here. From the 4, we take F from here. From the D, from the differences, we take the D from here. And the S, the last S of the difference, we take here, and we form it into an abbreviation. We call it as CFDs, which is known as contract for differences. Okay. So these are a kind of, you can say, a small mind map, which you can use to learn how Forex and the CFDs are derived. Okay, so it's pretty much simple. Now, asset variety. CFDs can be traded on a wide range of underlying assets, including stocks, indices, commodities, currencies, and cryptocurrencies. Okay. So CFDs can be traded on a wide range of underlying assets. Remember that. Okay. We can trade on stocks, we can trade on indices, we can trade on commodities, we can trade on currencies, we can trade on futures, we can trade on cryptocurrencies, and a lot. We can even trade bonds. Okay. And we can also trade metals, energies, and they are very there are various asset classes, which I'm gonna just show you later on in this video. Okay, contract mechanism. Traders enter into a contract with the broker to exchange the difference in the asset price, similar to the forex market. When you are involved in a forex market, or when you are involved in a CFDs market, just like the forex market, you enter into a contract with a broker to exchange the difference in the asset price between the contract's opening and closing price. Remember that. Okay. So market direction. CFDs offer flexibility, enabling traders to profit from both rising and falling market. As I told you earlier, unlike stock market, you can profit from both rising and falling market. In the stock market, you can only profit from the rising market. And when the market is falling, you either have to sustain the losses or you have to cut down your losses by selling your shares. That's it. Leverage effect. CFDs provide leverage, allowing traders to control larger positions with a fraction of total and trade value, amplifying both potential profit and losses. We have already covered this. No ownership. There is no ownership in the CFDs market, just like the forex market. And since there is no ownership of the underlying asset, this reduces the associated costs such as tax, stamp duty, and brokerage fees. Risk management. While CFDs offer opportunities for significant gains, they also carry risk, including market volatility, leverage, and potential for rapid losses. Okay, just like the forex market. Effective risk management strategies are essential for successful trading. Okay, now regulatory considerations. CFDs is subject to regulations in many jurisdictions. Remember that. Just like the forex market, the CFDs has to be regulated in multiple jurisdiction, okay, including the leverage limits. Now, every jurisdiction like US, UK, EU, Australia, New Zealand, they have a different leverage limits, okay? For example, in Australia, also for example, in the US, the limit of, what to say, the leverage limit is 1:50. So 50x is the leverage provided in US, allowed in US, while in UK, it's 30x. In Australia, it's 30x. Okay. And in New Zealand, it's 30x. In some other parts of the jurisdiction, okay, in some other jurisdiction, the leverage may go up to 100x, 200x, even 500x, and sometimes even 1000x. Depending on the jurisdiction, okay, you can have a good amount of leverage. Okay, you can utilize the leverage according to the jurisdiction. Okay, so exchange trading of assets review. Okay, now exchange trading of assets. Now, what is exchange trading of assets? First of all, we have covered Forex. Then we have covered CFDs. Now, the third part is the exchange trading. Exchange trading is when you are trading on a centralized exchange. Okay, remember that. For example, exchange trading of assets involves buying and selling of financial instruments such as stocks, bonds, commodities, and derivatives on an organized exchange. Remember that, on an organized exchange. On when there is a central exchange or an organized exchange involved in your trading, okay, you are basically dealing with the exchange trading of assets. These exchanges provide centralized platform where buyers and sellers can come together to execute trades transparently and efficiently. Okay. Now, exchange trading offers liquidity, price transparency, and regulatory oversight. When you are trading on in an exchange or using an exchange, for example, when you are trading the US stocks, you are basically either trading on the NASDAQ exchange or you are trading on the New York Stock Exchange. Similarly, when you are buying or buying the shares of the UK stock market, you are actually trading on the London Stock Exchange. Okay, so so because of the liquidity, price transparency, and regulatory oversight, exchange trading is very, very attractive to investors and traders. But because there is a because there is a minimum capital requirements. For example, in the US, you need to have a $25,000 account, okay, or a $25,000 US dollar capital in order to participate in a stock market, okay, this is known as a day traders rule, okay. In Forex market, there is no such rule, okay. In CFDs market, there is no such rule, but in the exchange trading of assets, there are capital requirements. So many people or many traders, they don't have enough capital. So they ultimately turn towards Forex market or the CFDs market, okay, because there are low entry barriers. All right. Assets trading on exchange, okay, stocks, equities, bonds, or fixed income securities, commodities such as gold, oil, and agriculture products, and derivatives like option, futures, and exchange traded funds, which is known as ETFs. Okay, investors and traders can access exchanges through brokerage accounts and trading platforms, enabling them to participate in the market and execute trades electronically. Okay, exchange trading facilitates price discovery as supply and demand dynamics determine asset price through continuous trading sessions. Okay, remember that. Okay, and exchange trading operate under regulatory frameworks to ensure fair and orderly markets, protect investors, and maintain market integrity. Okay, these are the benefits of the exchange markets. Okay, but remember that. Okay, exchange markets or the exchange trading assets. Okay, exchanged trading traded assets, okay, they have one drawback. Okay, these markets are not 24/7. These markets are not 24/5. They are open at certain times for 5 to 6 hours per day in in different jurisdiction. Okay, so they have a specific timings, okay? And you can only involve in trading during these specific hours. So normally 6 to 7 hours per day, you can be involved in a stock market. In Forex market, you can be involved 24 hours a day. So that's a great benefit of a Forex and CFDs market. Now, asset variety. Exchange trading encompasses a wide range of financial instruments, including stocks, bonds, commodities, and derivatives. We have already read that. Okay, centralized platform. Organized exchanges provide centralized platforms where buyers and sellers can come together to trades execute transparently and efficiently. We have already covered this. Liquidity and transparency. Exchange trading offers liquidity and price transparency, allowing investors to buy and sell assets at competitive prices. Regulatory oversight. Exchanges operate under regulatory oversight to ensure fair and orderly markets, investor protection, and market integrity. We have already covered this. Okay. Investors and traders can access exchanges through brokerage accounts and trading platforms, enabling them to participate in the market and execute trades electronically. Okay, exchange trading facilitates price discovery through continuous trading sessions where supply and demand dynamics determine asset prices. We have covered this again and again. Risk management. Investors can manage risk through various strategies, including diversification, stop loss orders, and hedging using derivatives. Okay. Market efficiency. Exchange trading contributes to market efficiency by incorporating new information into asset pricing and reflecting investors' collective expectation about the future prospects. Okay. Exchange trading of assets provide investors and traders with opportunities to build diversified portfolios, hedge risks, and participate in the growth and development of financial markets. Now, we have covered basically pretty much about the basics of forex trading, CFDs trading, and the exchange trading. Okay. So let me write down more. Okay. Forex trading. And we need to do one more addition. Oh, all right. All right. So you will be provided with this document, and during this mentorship session, okay, I will upload this video in the YouTube as well, and I will also post the link of this document so that you can review it over and over again to get a clear idea of what we will be covering. So this was basically episode 1. We're gonna conclude this video here, and we're gonna move to the next episodes in the upcoming times. Okay, so my advice is that you should read this document very clearly. You should read this over and over again so that you get an idea. So uh, the tip and advice here is to read this part of the document 3 to 4 times so that you can understand everything. All right. Okay, so I have basically explained you most of the things, but of course you have to reread it, read it over and over again in order to get an idea. If you don't have these basics idea, you won't be able to perform uh, uh, you won't be able to perform accurately in the Forex market or the CFDs market. Remember that this introductory part is the basic cornerstone or the foundation stone of your future mentorship. So you have to read this over and over and over again to get a clear idea about what is Forex trading, what is CFDs trading, and what is the exchange trading. You also have to uh, understand the key features associated with forex trading, CFDs trading, and the exchange trading. Okay, so that's it for now for this video. Okay, we gonna cover the next part of these mentorships or the next part of the document in the upcoming videos. So in the next video, I gonna be covering forex market participants. Okay, that would be the episode number 2. The episode number 1 has already been concluded. So you just have to follow this document, read it again and again so that you get a basic idea and the foundational knowledge of exchange trading, forex trading, and the CFDs trading. That's it for this video.